Jerome Powell specifically said, no, a soft landing is not our base case. We understand economic pain is probably coming, recession's probably coming, yet our outlook is still we're going to stay very tight.
What's up, guys? I'm nobody special, and I'm very happy today because I have my good buddy Joe Brown from Heresy Financial. He is one of the best in the business when it comes to financial YouTube, and he is here today. He's going to talk to us all about what is going on in the debt market, especially after yesterday's Federal Reserve meeting and Jerome Powell's press conference. Joe, how you doing today?
Pretty good. Thanks for having me. Lots of crazy stuff going on, so I'm excited to be here.
Indeed, there is lots of crazy stuff going on, and thank you for making the time because I know you're a busy guy. You put out a lot of content on your channel. Check out Heresy Financial, by the way, guys. I'm going to put a link down in the description. Again, one of the best in the business. So let's start off real broad, Joe. We had Jay Powell's press conference yesterday. No big surprises with the lack of a rate cut. I think the market had pretty much universally accepted that, but we still saw a pretty strong reaction. What do you think happened yesterday that the market reacted so strongly to?
I think a couple of things. Number one, after the dust had settled, it was pretty clear that Jerome Powell specifically said, no, a soft landing is not our base case. And I believe he actually interrupted somebody to say that, like during the middle of their question, to clarify. He was like, no, our base case is not a soft landing. And so that's number one, basically signaling, hey, like we understand economic pain is probably coming, recession is probably coming. And so we're not anticipating this is going to be a nice, easy ride, yet our outlook is still we're going to stay very tight. And that bleeds into the kind of the second thing that I think the market started to digest, which is that over the last, 2.5 years, ever since the Federal Reserve said they were going to start raising rates, letting their balance sheet start to bleed off, the market never believed the Fed. When the Fed said, we are going to taper, we are going to tighten, the market said, no, you are not. You can't do it. The going line was you can't taper a Ponzi, right? And they did anyway. And as soon as they started, everybody said they'll have to pivot. They'll have to pivot. They'll be forced to pivot. They can't keep this up for long. They can't move rates too high. Sure enough, we're now at Fed funds rate that's higher than it was since, I think, 2007, if I remember correctly. And they're holding strong there. Inflation hasn't come back down to 2% still. And they've tightened for, number one, a lot higher than people thought, a lot more, and for a lot longer. And the consensus was that that would never be able to happen, and it happened. And now they're signaling we're going to continue to stay tighter for longer. So the market is now not pricing in, I believe, any rate cuts next year, which is, massively different than, what they were pricing in like a year ago. And so as a result of that, long-term yields are starting to surge higher, which we can get into. And it's interesting because that's not happening to short-term rates.
Yeah, you touched on a couple of things there, really good topics. The soft landing narrative. I was in disbelief this morning when I did my live stream. I brought up an article from Bloomberg. I don't have it handy, or I'd put it on screen now. But this analyst at Bloomberg basically said the main takeaway from yesterday's press conference was that the soft landing is now the most likely outcome. And that is the exact opposite of what Jerome Powell said during his press conference. To your point, he actually interrupted the question. He never does that. And yet that's the conclusion that the press draws, which means that article was probably just written before the press conference even happened. And they're like, good work, Johnson, just take it to print. You also mentioned that the Fed had moved higher than most people anticipated, and that we've now been in this hiking cycle longer than most anticipated. And I'm in agreement on both cases, but they also did it faster than anybody anticipated. Those 4 or 3 consecutive 75 basis point rate hikes. And I think that's probably a lot of people are discounting or not quite factoring in just how significant that is because of the lag. Could you talk a little bit about the lag and why the speed of the rate cuts is also a factor here and how that might play out in the months ahead?
Yeah, speed of the rate hikes. Yeah. So myself included, when they first started talking about this, I was saying there's no way they're going to be able to do it. If you look at the last 40 years of interest rates, they start to raise rates, and at some point something happens and it forces them to cut. And that point at which it forces them to cut gets lower and lower every time. And so we were at a place where I was like, look, based on just continuing this trend, if they start to raise rates right now, the highest they'll be able to get to is like 1.5%, maybe 2%, and then they'll be forced to cut. And they just blew right through that and kept on going. And so the speed at which they, especially at first, were raising interest rates, and now the time in which they've held it high is significant, to your point, because of the lag in monetary policy. So this is like the Cantillon effect. This is how monetary policy does not equally hit all parts of the economy at the exact same time, equally distributed. So when the easing first started, like when you look at 2020, they printed $3 trillion. The very first thing that happened, like immediately, was asset prices exploded higher. And that was before the money hit anything. Like the money hadn't gone in. It was still in the government's checking account. Like the money hadn't done anything. Stock market blew up higher. Real estate blew up higher. Bubbles started forming everywhere, like in crypto. So asset prices immediately spiked from that. When you look at the CPI, it wasn't until March of 2021, so a full year later, where the CPI finally got back to what it had been on average for the last like 6 years, which was around 2.5%. So March of 2020, the CPI dropped, and it didn't get back up to 2.5% until March of 2021. And then from there, it exploded to, the record highs of, 9.1%. And so the reason for that is because monetary policy works its way throughout the economy with a lag. So it didn't hit all that new money printing didn't hit goods and services until at least a year later, working its way into like a year and a half later. And then it was after that, once the cost of living went up, that wages started to increase, though not as much as inflation. We've had real wage decreases for the last 3 years. And so you have this effect where monetary policy hits assets first, then goods and services, and then wages. It's the same exact plan or progression with tightening. And so first it hits asset prices. That's why you got that fall in asset prices, especially stocks, at the end of 2021 when the easing stopped. We've seen disinflation hit goods and services, but we still definitely have not seen the full extent of that tightening hit the economy yet. And so especially when you look at wages being the last place for it to hit. And that can come through in wage cuts. That can come through with job losses. That can come through in a number of different ways. But we have yet to see the full extent of monetary policy tightening hitting our economy.
Yeah, I've been using the acronym or the analogy recently of stubbing your toe, like on a chair or on a table, right? When you first stub your toe, you just messed something up. It's going to hurt, but it hasn't hit your brain yet, and you're bracing for it. It's coming, and oh, here it comes. Oh, that really hurts. Yeah. That's kind of where we're at right now, right? The rate hikes was stubbing the toe. The pain is coming. We know it's coming. Powell has referenced it several times. The lag, he said we can slow down and be careful. It's kind of Fed speak for we know we broke something. We just don't know how much yet, and we're going to slow down and wait for that to happen.
Yeah. Yeah, so, you can see that in the debt numbers. I mean, interest rates moving up on the most over-leveraged economy in history causes severe economic pain because the cost of servicing the debt goes up, the cost of deleveraging goes up, and the results of some inevitable defaulting get more painful. So, and that hasn't started to hit yet.
Along the line of rising interest rates, I got tagged by somebody on Twitter today on one of your tweets. And that was very fortuitous because I was like, oh, I'm talking to Joe in a few hours. Why don't we mention that? So I'm going to bring up this tweet that you put out there. You mentioned this. I'll read it to you. You said the yield curve is uninverting. It has done this before, but normally from the short end going down, meaning usually the yield curve uninverts because the Fed lowers rates, but not the long end surging higher. Much of this is due to the Fed's repo facility, which acts as a floor under short-term rates and a soft cap above them. As short-term rates move slightly higher, it sucks funds out of the reverse repo, which keeps rates down. We've been watching that happen. There's a $1.4 trillion left to keep holding short-term rates low here, but no such buffer exists for long-term rates, and the government borrowing just got started. So you're alluding to what we've seen, the very strong reaction in the long end of the yield curve that we've had over these last few days, the 10-year, 30-year, the 2-year, they're all heading higher, but that 1 month still anchored at 5.38 to 5.4. So the yield curve is uninverting here. Could you add a little bit more color here, especially as far as how reverse repo plays? Because I know that's a big factor in what we're seeing in the debt market right now, but I think it's probably one of the lesser understood factors that's out there, and people don't realize just how important that is.
Yeah, absolutely. So let's go through this point by point. First, the yield curve is inverted. Normally, in a normal environment, if you lend somebody money for a year, you're going to demand a lower interest rate than if you loan them money for 30 years, because the longer the maturity on that debt, the more time there is for something to go wrong, something like inflation happening. So you want a higher interest rate. That's why 15-year mortgages have usually better interest rates than 30-year mortgages. That's a normal environment. In certain circumstances, that yield curve inverts, which is like right now. Short-term debt has a higher interest rate than long-term debt, which seems counterintuitive. Why would that be? Usually, the bulk of that is because the market expects we're going to have a recession at some point soon. Therefore, the Fed will lower interest rates. That recession will maybe cause some deflation. So in the future, interest rates, a normal interest rate might be 2%, but right now interest rates are 4 or 5% until we get that Fed pushing the short-term interest rates down. So the inverted yield curve is the market anticipating a recession. Now, what the steepness of the yield curve and of the yield curve, the inverted yield curve, and the length of time that it stays inverted, those things together signal how severe the recession will probably be, historically speaking. So based on those two factors, how steep that inverted yield curve is or was, and how long it's been inverted, are signaling we have a big recession ahead of us. Now, when this yield curve uninverts, usually that's from the Federal Reserve pushing short-term interest rates down. Now, that has happened for the last 30 years or so because there's been no inflation or lower inflation than there was before. So for the last 40 years, we've been in this environment where inflation has been doing this, coming down with this disinflationary environment cycle for the last 40 years, and so have interest rates. And so the Federal Reserve has the room to push interest rates down because they're not at risk of reigniting inflation. Well, that's not true right now. And that's why this time was different than like the end of December 2018 or 2017, when the Federal Reserve was trying to tighten and then they couldn't because the market started to sell off. And let's see, that was
Christmas 2018. I remember. Yeah. Yep. 1,000 points down on Christmas Eve. Yikes.
Right. Yep. And so they pivoted because they had no reason not to. There was no inflation, according to the CPI at that time. That's not the case right now. And so if they budge and ease again, then they are risking causing even more inflation to, fire back up again. Now, so you're looking at this and you're saying, okay, well, interest rates are still a factor of supply and demand because the Federal Reserve doesn't directly control the yield curve. They only control the short-term interest rates, but they don't control what the government pays. Those are set, they're influenced by the Fed, but not controlled by the Fed. And so there is a free market element to that where it's just supply and demand. The government borrows money at certain maturities, and a bidding takes place, an auction takes place, and determines what those interest rates are. So you might be asking, well, why in the world is there, are those short-term rates staying where they are, and why are long-term rates surging higher right now? Part of it is because of that economic pain inflation cycle changing, interest rates staying higher for longer. But right now, short-term rates really can't budge much from where they are because of the reverse repo facility. So I have a picture up there. If you can expand the picture underneath that tweet of the reverse repo facility. I think it's the third one. Yeah.
This one here.
Yeah, so this is a facility that the Federal Reserve opened up for use or started incentivizing the use of in April of 2021. That's when it really started to shoot up. Basically, they started paying an interest rate in here. And so they said, hey, financial institutions, if you put cash in here in exchange for the collateral you need, instead of buying that collateral on the open market, we'll pay you an attractive interest rate to keep your cash in here. And so that sucked in over the next year and a half to a $2.4 trillion into this facility, earning, a fantastic interest rate. This is all short-term cash. And so this is cash that people put in like money market funds. And so when you look at like T-bills, which is the short-term US government debt, if the government wants to borrow short-term debt, it cannot offer 5% right now because you can get risk-free 5.35% from the reverse repo facility right now. So if the government wants to get anybody to lend them money at the short end of the curve, they have to offer at least what the Fed is offering in the reverse repo facility. And so that's why short-term rates like T-bills have moved up a little bit recently. They're currently, 5.5%, 5.54%. That's just enough to start attracting money out of the reverse repo facility. So you've seen that chart start to fall. There's only $1.4 trillion left in there now. If the government came out and said, hey, we're going to offer, we're going to borrow a ton at the short end of the curve, and you'd think, okay, well, that should push interest rates up to 6%. Well, suddenly that would suck all the cash out, and that auction process, that demand would push those rates back down. So there's $1.4 trillion getting paid 5.35% right now, risk-free from the Fed printing. And anytime short-term debt is available with a little bit better, it'll suck a little bit out of the reverse repo facility. And so it's operating as both a hard floor underneath short-term rates and a soft cap. And once this thing hits zero, there's no more soft cap on short-term rates. So that's why we don't see short-term rates moving right now, and we do see long-term rates moving right now, because the federal government is borrowing like a madman right now. They've increased the national debt by $1 trillion in the last 90 days, I believe, if my numbers are correct. And it's not slowing down anytime soon. Why is that? Because one of the biggest reasons why they have to keep on borrowing more and more right now is simply just to pay back all of the short-term debt that's maturing. In the next year and a half to 2 years, half of the national debt is maturing, which means they have to borrow $16 to $17 trillion in the next 2 years just to pay off that $16 to $17 trillion. But that's low interest rate debt, 1 to 3%. And they're borrowing at 4, 5, 6% to pay that off. And so just the debt itself is causing the debt to grow. And just the interest on that debt is causing the current borrowing to grow. So this is called a debt spiral. And that's what we're facing right now. But we know we've got like a $1.4 trillion buffer before things start to get kind of crazy.
So let me ask you to speculate a little bit here, because nobody knows. This has never happened before. What happens when this gets to zero? Give me your best guess. I'm not going to hold you to it. Just give me your most informed opinion about what happens.
All right. So we have a couple different ways that this gets dealt with. If there's no plan and just borrowing like crazy across the curve, then all interest rates, go up. Based on supply and demand and the auction, I would expect an extreme reinverting of the yield curve, but all interest rates moving higher. The Federal Reserve still has trillions of dollars of government debt on its balance sheet, though. And it's letting some of it bleed off for sure, which means some of it has to get paid back, and the Fed's not currently printing money to roll all of it over. Most of it, but not all of it. And so the Treasury, in coordination with the Fed, can engage in a sort of operation twist, where as the debt matures that the Federal Reserve owns, and as the debt matures that the federal government owes back, they can coordinate that and say, okay, well, right now, because of where this debt is held, what's maturing, we can borrow more here, pay off some of this, and then later we'll borrow more here and pay off some of this to try and equalize and balance out so that you don't get crazy disruptions in the Treasury market. Because crazy disruptions in the Treasury market don't look good for financial stability. And so I would expect once this thing hits 1.4 trillion that we may not even know about it, but there will be coordination between Yellen and Powell about how the Fed lets the treasuries bleed off of its balance sheet and what durations the federal government is borrowing at in order to make sure that you don't get crazy little spikes here and there as they have to borrow.
So you mentioned coordination between Yellen and Powell, the Treasury and the Fed. It's interesting because I picked up on some things. I'm wondering if you picked up on it yesterday in Powell's press conference. Powell mentioned a couple of things that, if you read between the lines, the Fed and the Treasury, the Fed and the White House, or the Fed and Congress, however you want to phrase it, they're not exactly in coordination right now, are they? They're almost working at cross purposes. What do you see playing out there? What is happening between the Fed and the Treasury right now?
Yeah, well, even in the last press conference, it was really interesting because, or maybe it was two times ago. I don't remember exactly the date, but somebody specifically asked, saying, "Hey, we know the fiscal situation with the government is crazy right now. They're like, debt spiral, digging themselves into a hole. What are your thoughts on in the future the Federal Reserve coordinating with the government to help refinance the debt?" And it was a little bit awkward, but kind of funny. He literally just said, "Under no circumstances," and then went silent, like no further explanation. So it was a couple of ways that could be interpreted. Number one, it is actually illegal for debt monetization, outright debt monetization, to happen. So the Fed can't print money and loan it directly to the government. It's not possible unless the Federal Reserve Act is rewritten, the law changes. So that can't happen. So that may have been what he was referring to, is we've never done that in the past. We'll never do that in the future. Can't happen. It could have been a soft or hard message that he's sending to Congress and the government, saying the Federal Reserve is not here to help out with the financial irresponsibility of the federal government, even though the Federal Reserve basically enabled this last big, every single big bucket of this, by buying up all of this debt on the open market for quantitative easing. Same thing. But now that there's inflation and now that things have started to get really out of control, he's basically potentially saying, we're stepping back and we're not gonna help this go any farther. The federal government must figure out a way to get its finances under control itself. No more QE from us. And so that's definitely still the case. I haven't seen, to your point, based on the language that was being used, I don't see any signal, any idea, any hint that will change right now. That's part of the whole reasons for the Federal Reserve's independence, is so that they can do things they think are good for monetary policy, independent of what the government does with fiscal policy. But that doesn't mean that there is no coordination between them on basic market functioning. The Federal Reserve does have jurisdiction over and responsibility over the general soundness and safety and security of the banking system and the financial system. So it may look at its balance sheet of treasuries and say, hey, this is what they actually do right now. They make sure that they let specific maturities get paid back and rolled over, and repurchase things based on just allowing a very soft, smooth curve bleed off of the balance sheet. They don't want to themselves cause any disruption just because this week a huge chunk of it happened to mature. No, they're going to roll over some of it. And so there's no incongruity with doing that and working with the Treasury itself on the Treasury's issuance of new debt to make sure that that market functioning is smooth. There's no that can happen perfectly fine while the Federal Reserve is also saying we're not gonna help you dig yourself out of this financial hole.
Well, that's what we have. John Fetterman and his gym shorts and hoodie, and somebody could hit Control-Alt-Delete and reboot Mitch McConnell, and I'm sure they'll get their act together any day now, and the Fed will not have to go to such great lengths. I have the utmost confidence in our elected officials.
Right.
I'm sure we're in good hands. Lastly, I know we're running over a little bit here, but I want to get your take on this very, very quickly. The glitch that we saw Sunday night into Monday. All right. Everybody was talking about it Monday morning. Nobody knew what had just happened in the bond market. There were some pretty strong opinions being thrown around. Some people said it was definitely not real. How could you believe that was real? That can't happen to the 2-year Treasury. And then you had other people saying it was repo madness all over again. They're hiding it. They're covering it up. And you did a very good job of kind of walking a tightrope in between the two camps, but you had the best explanation I've seen of what the heck that was Sunday night. Give me your speediest version of it. What was that?
Yeah. So I think it was actually a bit of both going on. So you have a lot of uncommon action taking place in Treasury markets right now. You have, number one, a historically high long bias with U.S. Treasuries right now. When you look at asset managers and hedge funds, it's like historically, like the consensus is go long Treasuries. And that looks like that's really very recently starting to flip. You have hedge funds flipping on their trades, their net trades on the dollar as well. And so you have a lot of trades flipping right now. You have an increase in the basis trade by hedge funds right now, which is a relative value trade between cheap repo funding, and then the arbitrage between that and short-term Treasuries. And so you have all of these things right now that if you have to unwind them super quickly, they can cause major disruptions in Treasuries. And so when you take a look at something like a misprint, that happens all the time. So I pointed out that on the 6-month, I believe, on July 20th of this year, yes, on July 20th of this year, there was a misprint where it looks like the yield traded up at like 6% or something, which it didn't. It was just a misprint. So that if a misprint happens, it's basically like it looks like a trade happened at a certain price that gets recorded by all of the trading platforms that receive the data. And so then it looks like something crazy happened when in actuality, it was like, no trade happened there. Or sometimes somebody fat fingers something. A trade does actually happen, and it was an erroneous trade, and the trade gets busted. So it gets unwound, it gets undone. That happens as well. It happens in stock markets, that happens in bond markets. And so it's not anything unusual. What was unusual was the coordinated price action across the entire yield curve. Not to the same extent, but you did see a big spike in yields across the entire curve, and then a subsequent fall right back down. And so it does look like there is disruptive action taking place in the Treasury markets right now. And the Federal Reserve themselves warned about this just a couple of weeks ago, saying, hey, we're seeing an increase in the type of trading, in the sheer volume of certain types of trading that are highly leveraged using Treasuries that could absolutely cause disruption in Treasury markets. And so I do think we saw that, and that could have absolutely contributed to the glitch happening where it's like, oh, one trade went through bad, or there was a misprint or something like that. And so that glitch itself is, in my opinion, kind of meaningless, but everything else that happened at the exact same time shows, hey, things are getting a little bit dicey. As I've been saying this for like 6 months now, yields are heading much higher, much, much higher.
So correct me if I missummarize here. It looked like the big move in the 2-year may have been a glitch, either a misprint or somebody fat fingered a trade. But while that was going on, you also had some kind of an unwinding going on across the long end of the yield curve. And that's why it affected the 1-year, the 2-year, the 10-year, and the 30-year, why they were all moving anyway. Maybe the 2-year was an outlier and somebody within that whole thing messed it up or misprinted, but there was an underlying move in those other asset classes during that time.
Correct. Yeah.
Wow. Well, that was, I remember watching that video you put out yesterday. That was very well done. Thank you for doing that, because I was sitting there Monday morning scratching my head. I even made it the title of my live stream, WTF just happened in the bond market. And it was eerily reminiscent of repo madness. It didn't look exactly like it, but the timing of it, the quad witching, even the date, it was eerily reminiscent of 2019.
Yeah. Yeah, definitely. Yeah, these things are all flags, all signposts. In and of themselves, they may be meaningless. When you start to see these things pile up, it's a sign of it is a sign of something deeper going on. Cracks starting to appear in the financial system.
And one more thing we got to touch on is I am really looking forward to having a drink with you in Las Vegas in just 8 days, 10 hours, 20 minutes, and 55 seconds as of this recording. We've got the Silver Symposium coming up. You will be there. I will be there. Ninja, Chris, a whole bunch of other YouTubers are going to be there. Tell us about what you're going to be talking about. Give us a little hint about what Joe's going to be talking about at the Silver Symposium.
Yeah, I'm going to be talking about the history and the future of sound money and how that influences economic activity. And so not only is it just like nice to think about, oh, the good old days when there was deflation and sound money, and hope we can get that again in the future, but how you can actually live in both worlds. And even today, you can set up a quasi sound money standard for yourself to put the right parts of your financial life in and still have one foot in the current world where you're not trying to barter with silver coins for your rent payments or your mortgage payments. So we can live with 1 foot in each world and have accrue the benefits from each.
All right, you got my attention. So you don't have to go full Obi-Wan Kenobi and trade silver with the Jawas for droid parts. You can actually have some, for lack of a better term, some imperial credits in the system at the same time while also protecting your independence. Fantastic.
Exactly.
Well, Joe, I'm looking forward to seeing you in Vegas, and I will be there also. I'm doing a whole bunch of panels. I'm going to be talking about some of the pitfalls in precious metals investing, some of the ways that a consumer can arm himself with knowledge and protect against maybe some of the, I don't want to say predatory, but hey, metal traders, people who deal in this stuff, they're out to make money like everybody else is. So a way that you could be a more informed consumer. I'm also going to be talking about the NVIDIA CoreWeave story that we talked about on your podcast. So really looking forward to Vegas. Folks, there is a link in the description down below. There's still time. You can get 10% off your tickets if you use that affiliate link, and you can come out. You can meet Joe. You can meet myself. Let's get together and let's hang out. And I'm really looking forward to your talk, Joe. And I just want to say thank you so much for taking the time to talk to us today and sharing your knowledge with us. I'll give you the last word. Anything you want to close on?
No, I'm looking forward to your talk as well and seeing you there and hanging out with everybody that comes to hang out with us as well. It's going to be a good time.
Outstanding. Once again, folks, that was Joe Brown from Heresy Financial. Link down below in the description. Check out his channel and always tell him nobody sent you. And until next time, live small and dream big.